Hey guys, welcome to the personal finance. I hope you can see me. Let me cross check it if things are all right. Hold on just a moment. Yeah. So, welcome again. And this is our third streaming, and we want to discuss something about mutual funds. And everybody says invest in mutual funds, right? The question is now that which fund to invest, right? And this is not a streaming wherein I'm going to tell you which fund to invest. I'm going to tell you how do we select uh, the the funds, right? What are the parameters to select the funds? Nothing to do with if you are here to find out which funds, like be it HDFC, ICICI, or you know whatever fund names are there. This is not for you. So this is I'm not presenting you here the fund names. Okay. So what I'm going to explain here is certain aspects of mutual funds. That what is that one should be looking at, right, in terms of selecting mutual fund. There are certain terms of mutual funds. That is what we will explain today, right? And this especially means that okay, fine, like a beat expense ratio, beat whatever. That's what we are going to discuss today, right? And 4 or 5 key terms, very very important to figure out that what those terms are. Okay, so now let's get back to our presentation. Typical presentation mode is what we'll get back to it, right? First of all, disclaimer that I always keep telling you guys, right? I am not a financial advisor. Okay, I would highly encourage you to go ahead and get a financial advisor. This is not financial planning is कोई बच्चा का खेल नहीं है, right? You should go ahead for a financial planner, and more importantly, you should go ahead with an investment advisor. Okay, I would highly recommend you to go ahead with an investment advisor, and they are the ones who can give you the right advice, right? They may or may not spend as much time with you, maybe 1-2 hours, but then or 3 hours max. But they will certainly give you a consultation of whom should you invest your money with, right? Which mutual funds and things like that. Okay. Yeah. So since that is out of the way, I want to show a couple of things to you because I wanted you to see once again, why is that we have started this channel. This channel is primarily for education, financial education for people, right? In that journey, what we have managed to get is we have managed to get few of the corporate trainings, right? We have managed to get 1,000 subscribers plus, right? So if at all you for your organization want a free corporate training, right? We are very much into it. We can do a weekend corporate training. In doing so, in showing education, my whole idea was that I do not want everything. This could be a no profit, no loss sort of channel wherein I'm just raising some funds, right? I'm primarily raising some funds so that we can have webinars with large number of people. Right now they are pretty expensive. We cannot do it. So I'm just raising funds. If you want, you can join our community. Of course, community has its own benefits, be it a priority planning for you and things like that. Very much okay, right? We can definitely have that for you. Okay. So help us raise some funds if in case you want to join the cause of giving financial knowledge to the community, right? Primarily financial independence knowledge. Okay, so let's start ahead and let's start. Since this disclaimer is out of the way, we'll get started. So one key important thing is this: past performance is not an indicator of future results. Okay, I want you to take this very very seriously, right? This is not that I want you to forget. The past performance of any mutual fund is not an indicator of future results. So whatever parameters you are going to choose, okay, are the parameters which are not to be really taken too seriously, obviously, right? What I mean is that you have to be really, really careful in picking up any of the mutual funds. Okay, so past performance is not an indicator of future results. Be very, very, please be very careful about this thing. Okay, so what does these terms mean when you go ahead and pick a mutual fund? Now getting to the meat of discussion, right? When you get to a mutual fund, you select mutual funds. What is this that you mean? What is alpha? What is Sharpe, whatever, right? What is beta? What is standard deviation? What do these terms mean? What exactly these terms mean? How should you pick up a mutual fund by selecting this? What value should these be? Right? This is what we are going to discuss today. Okay. For example, right, the important terms to understand apart from this alpha, beta, Sharpe ratio, and standard deviation is also fund size, fund category, expense ratio, benchmark index. Okay, there's also a very important aspect of selecting mutual funds is, and I will not take much time for the things on the left hand side: fund size, funds category, expense ratio, and benchmark index. I'll probably take a little more time on expense ratio, but then let me quickly briefly touch about fund size. The fund size is obviously, the amount of rupees, the number of people who have gotten into that fund, right? If you go to any financial planner, their first preference would be, and if you are at a retirement juncture, say about 35, 40, 42, 45 years of age, their primary feedback would be that pick a fund size which is a little bit higher or maybe highest, right? They would say that. Based on your age, based on your, they may say, okay, fine, wherever the fund is running from not many years, you pick up that fund is what the recommendation would be. Okay. Then comes fund category. Fund category is extremely simple. Fund category is basically mid cap, large cap, whatever sort of fund category it is, right? With multi-asset or whatever sort of fund it is, that's the fund category. Benchmark index is basically if you are going with bank index or Nifty, whatever, Nifty 50 index, whatever you want to go to, there's a benchmark in that particular category. That's what benchmark index means. And expense ratio is something that is extremely important for you guys. Before we come to the right hand side, alpha, beta, Sharpe ratio, and standard deviation. Expense ratio is something that is the ratio which is the percentage money that they charge you to run the mutual fund. Okay, to run the entire mutual fund. Just a little double click on what is expense ratio, right? You guys can read it, but I'll just try to put a little bit more aspect onto it. For example, let's say a mutual fund has an expense ratio of 1%. Okay, that means that you are giving 1 rupee for every 100 rupees to ensure that the fund is managed, right? When I say somebody is managing, the people are paying salaries for it, the asset has to be managed, operating expense of the fund, and all those things. So this expense ratio should be as low as possible, right? Should be as low as possible. Now, mind you, there are two ways that you can have a look at this, right? One is obviously that the distributor fund that you can get, right? Or one is direct, right? If you go with direct mutual funds, the expense ratio is generally lower. If you go with distributor-led regular plans, the expense ratio is more. I'm not saying one is good and one is bad. You have to just check, right, which is good and which is bad in terms of selection of funds, right? So expense ratio becomes an extremely critical thing to select a fund. Okay. Now, coming next to one important thing that I was talking about is alpha, right? What is alpha, beta, Sharpe ratio, and standard deviation? In all our calculators that you guys will be knowing that we give freely, right? Our calculators are free. If you want Excel calculators, just email us and we'll be giving it for free, right? There are a few parameters that we punch in those Excel sheets. Those parameters is what I wanted to explain to you today. Okay, so assume that you are playing a game, right? So alpha of a mutual fund, right? It's basically means how good is the fund manager in really picking up winning stocks, right? That's what it essentially means, right? It means that the fund manager is not just following the crowd, Okay, they're actually working really hard, and the fund manager is working really hard and getting the best out of the selection. That's what alpha means. Alpha means the fund manager is really going to pick winning stocks for you. So alpha has to be really good. Right? Now, what is beta? And I'll show you with an example. Just stay along with me here. What is beta? Beta, if you're playing a game, is the kind of difficult level of game, right? It basically means that a high beta means the fund is riskier. So obviously beta value has to be lower, right? And I'll show you some real example that what these funds and what sort of funds we are looking at and things like that. I'll just log into one of my accounts and I'll show you what this means, right? So beta, for example, a fund can go swing up or can swing down, right? So beta will show that a fund is riskier or not riskier. That's what the beta will show essentially, right? For in the layman terms. Now, just if you see what the values of alpha and beta should be, alpha means that if there is a positive alpha, right, it means that the fund has outperformed its benchmark. Of course, it means adjusted for risk. That means the fund manager has added value through their investment decisions. That means they have done some work, some good work, right? Negative alpha means that the fund has underperformed its benchmark. Very simple, underperformed its benchmark. Koi benchmark, right? Benchmark, whether it be bank benchmark or Nifty Bank, whatever, XYZ, it has underperformed its benchmark. Negative alpha means. This says that what? It suggests that the fund manager has not added any value at all. Right? They have made poor investment choices. Very simple. So if there is some negative alpha consistently, you may decide on whether you should pick up that fund or not pick up that fund. Okay. If it is zero, it means that the fund has performed in line with its benchmark, adjusted for risks, right? This means the fund has neither added nor subtracted any value, right? Next, you come to beta, right? Beta means, what's the interpretation of the number beta, right? Not getting too mathematical about it, but then beta means if beta is equal to 1, right? The fund's volatility, that means how the fund moves up and down, right, is similar to market. That means if the market goes up by 10%, the fund expected to go by 10% as well. That's what beta is equal to 1 means. And I'll come to it again, just bear with me for some more time. I'll give you some more details shortly. Okay. If beta is greater than 1, less than 1, beta is equal to 0, fund does not correlate to the market, right? This is what it means. Very important. Now coming to something extremely important, which I wanted to dwell down deeply into, it is Sharpe ratio or Sharpe ratio, whatever you want to call. This is nothing but reward to variability ratio. This is like your overall score in the game, and it's based on this is what you have to decide majorly whether a fund is good or bad. Majorly, right? Majorly, I would say, right? So a high ratio, a high Sharpe ratio means that the fund is doing well compared to the risk it takes. And if you see any platform that is offering you mutual funds, it always shows you this in some form or the other, right? I'll log in and show it to you, right? So this is related to standard deviation. Standard deviation is very simple volatility. For example, if standard deviation of the fund is high, it just swings a lot, right? Lows and highs, it goes minus 5%, plus 20%, minus 10%, plus 30%. So this is the standard deviation which you will have to input in the calculator that we give free, right? This is the standard deviation that you have to input, and every other fund house gives the standard deviation. Okay, let's double click into it and find out what it is. More on Sharpe ratio. Now, this is extremely important. Stay with me right now. Now it means extremely simple that return of a portfolio, you know what's written, right? I mean, you have invested in mutual funds, you know what is your IRR, right? You know, okay, it has returned 18%, 19%, 10%, 5%, 6%, whatever. Now, the Sharpe ratio is computed with also something called as a risk-free rate. What's a risk-free rate? Risk-free rate means that take up any fund, essentially, probably in most of the cases, a government security, which is nothing but a bond, of a 10 years government bond, you can take up that rate. Say the government bond rate was 8%. That means it is a risk-free, right? So you have to have a benchmark kind of thing. That's a risk-free rate. That means as compared to a risk-free asset. Let us say, for sake of discussion, let's say the government bonds, the central government bonds that we get, right, is 8%. As compared to 8%, right, how has your fund performed? Very simple, right? So if that is what we have to compute, it means we need returns of your portfolio, a risk-free return rate, that is basically the bond rate, and standard deviation of the fund. Right? If we get these parameters, we can easily get a Sharpe ratio. And this, my friends, is extremely important in determining how good or bad a mutual fund is. For example, a portfolio has an expected return of 15%. Risk-free rate is 3%. Say a bond rate is 3% given by the federal government, right? Central government. And the standard deviation is 6%. That means the fund moves 6% up and down, right? It means the Sharpe ratio is 2, which is very good, which is very, very good in mathematical terms. Okay, that's what it means to have a higher Sharpe ratio. Now, imagine, for example, in a different scenario, right? Imagine if you're a baker, right? Trying to create a perfect chocolate chip cookie, right? So for you, for example, if you have 2 cookie recipes as an example, right? First recipe makes consistently good cookies, but they're not mind-blowing, right? Recipe B sometimes make amazing cookies, but often burns them. Okay, so recipe A makes consistently good cookies, but they're not mind-blowing. Recipe B sometimes make amazing cookies, but often burns them. So which is that you will go, which is the more riskier, right? Even though recipe B can produce the best cookies, it's high risk, inconsistent results. Right? So it makes it a less desirable choice. Recipe B can give you an amazing cookie, burns quite often, right? Inconsistent results. So not a desirable choice, right? So recipe A, which is consistent with good results, might have a higher Sharpe ratio, making it an overall better choice. That's the kind of analogy that I can give you. Okay, so for example, let us see one example here. Let's say HDFC Top 200 Fund, right? Say HDFC Top 200 Fund is there, and then it's a pretty popular large cap mutual fund, right? Say historical Sharpe ratio of this fund is 1.5. What the hell it means? It means if the Sharpe ratio is 1.5, it means, and this is exactly what you will see in any of the apps that you go to buy mutual funds. It means a Sharpe ratio of 1.5 means that for every unit of risk the fund takes, it generates 1.5 units of excess returns, right? 1.5 times of excess return it generates for the risk takes, for risk if the risk the fund takes. Very important, right? In simple terms, it's a good risk adjusted return. So you have to pick up anything, any funds which has a Sharpe ratio more than 1. A higher Sharpe ratio is generally better. And all these parameters, my friend, alpha, beta, Sharpe ratio, and standard deviation are available in any, pick up any fund, you can go there and they are giving it as a disclosure, right, of all these funds. Okay, next. As I said, skill of the fund manager, alpha shows the skill of the fund manager, right? Beta shows the risk level of the fund. Alpha has to be high, obviously. Beta has to be low, right? Sharpe ratio, overall performance adjusted for risk, has to be high, obviously. Standard deviation, how much the returns fluctuates, has to be low, obviously, right? So pick up a high alpha, low beta, high Sharpe, and low standard deviation. But as I mentioned previously, right, the first statement that I made in here, past performance is not an indicator of future results. Okay, so again, so you will have to do a lot of research to avoid this thing. Of course, you can connect with an investment advisor. You should, you must, if you ask me. I'm not one, but then I can make you free plans for you. As you can see, if you want a free plan, just drop an email to me down and you will have a free Excel sheet, and I can make a free plan for you as well, no problem, right? Just that you will be put in a queue because a lot of people are there who just want to have this plan, right? So, but Excel is free. You can have a DIY. Excel always will be free. I'm just raising funds so that we can have a webinar on financial planning. That's all. right? So again, it's a short, very short stream for you today, and I just wanted to show that the Excel sheets that we share to you, right? Expect one of those inputs to be put in, right? The Excel sheet that we present to you, expect one of the sheet. For example, I'm just to give to our subscribers is that, for example, write the standard deviation of Nifty, what you are seeing and stuff like that, right? That's what we keep asking people to write in our calculators, right? So this is what you will have to ensure to put in, right, in the Excel sheet that we share. So again, as I mentioned, the Excel is free. You can put an email to us, and you can make a free plan for yourself, DIY, right? Everything will be free for you, right? In terms of planning, there are goals. Hey Kapil, hi. I can see your chat. So Excel will be free for you, and you can definitely ensure that you can make your DIY plan, of course, right? No problem at all in doing that. I think we are coming to an end. I think we have another couple of subscribers have joined just now. I can see that. In case if you have questions, you can put an email to me, because this chat is only for members. You can go ahead and drop an email to me. You will get a free Excel sheet of planning, right? You can go ahead and have a DIY planning, no issues at all. And if you want this deck, of course, you can have this deck also. These are very simplistic things that we consider while making a plan, right? I'm not a financial advisor, but most of the advisor will ensure that you are having these details, right? They will not explain you anything, but they will just say, okay, fine, this fund is good and that fund is better, best, whatever. So go ahead and drop an email to me. You will get a free Excel, as the email ID is scrolling down. And thank you so much for being, and the ones who are watching it on recording, as I mentioned, please, this is very basic knowledge that I wanted to share with you. In case you want to have more detailed things, drop an email to me. I can have this Excel sheet forward to you. You can make a plan for yourself, DIY. Okay. Thank you so much, and bye bye.